Well, lenders now are saying the GP, people that are signing and guaranteeing the loan, they have to bring at least five, and as much as 10 or more of their own capital to the deal. If you want to take an acquisition fee, you're going to have, we call it net of fees, separate from that acquisition fee. So if you think about it, what people were doing before is they were using other people's money. They were walking away with a acquisition fee and they had no money in the deal. Lenders are not going to do that anymore. They want to see that the general partners have an investment in this of their own money. So you're starting to see, hey, I got to see your bank accounts. I need to see 3 months of your bank accounts. So they're digging in. They want to see operating agreements. Are you really on this deal? Or are you a co-GP that brought in other people's money? So, needless to say, the lenders are getting smart. They are looking for the right people to be signing on these loans.
Welcome to the Ironclad Underwriting Podcast, where precision meets performance in commercial real estate. I'm your host, Jason Williams, and every week we deep dive into the strategies and systems and stories behind rock-solid underwriting. Whether you're a seasoned analyst, an up-and-coming investor, or a commercial real estate professional looking to sharpen your edge, this show is your front row seat to expert insights, emerging trends, and real-world underwriting tactics that stand the test of time and scrutiny. From market assumptions to debt structuring, cap rates to cash flow, we're cutting through the noise and getting to the numbers that matter. So sharpen your pencils and fire up those models. Let's get to work. This is Ironclad Underwriting. Hey everybody, welcome to this episode of the Ironclad Underwriting Podcast. I'm your host, Jason Williams, and I got my co-host, Frank Patalano, and I got a very special guest, Julie Anne Peterson from Old Capital. How are you doing, Julie?
I'm doing well. Thank you so much.
So I brought you on, one, because I've worked with you on several deals. You're my lending, or Frank and our lending broker. And so you've been invaluable to me. Anytime I'm underwriting stuff, I can send you a text and say, hey, what are rates looking like right now? So I can put in real data into my underwriting. And so I always tell my students, hey, you need somebody you can reach out to and get real numbers all the time. I'm in the philosophy of who, not how. So I'm not saying you need to do everything yourself. No, you just need to know somebody who can do it for you. So that's who you are for me. So I greatly appreciate that. So
I'm so glad to help you and your team. That is really a key element in this multifamily syndication world, finding the right partners that will be there for you, even at 1 o'clock in the morning. So I'm happy to help answer questions, jump on calls, speak with your folks that may have some concerns. And also, we like to put you guys with our lenders directly so that you are building a relationship with them as well.
But you'll also step in when the lender or whatever, we are dropping the ball and maybe an extension isn't happening, and you can go and light some fires under some people's behind. So that is invaluable right there. So
that is not your typical lender. So
you've
nice
done that for us several times with some lenders, stepped in when things are going sideways. So again, that's why you need a good lending broker who's willing to do that. So
yeah, brokers are really, like you say, invaluable because we come to the market agnostically with your team. We're not representing a brokerage house, right? We're not having you go direct. We are working on your behalf, not on anyone else's but you. So that's really important. A lot of people feel a lot of pressure to work with, let's say, your agent or your broker team that also has a debt capital markets on their team. But if you think about it, they're only really caring about the transaction, about the seller, that the seller gets their deal sold and that they get paid, No one
Yeah.
is looking out for you. So real important to have a broker that works specifically for you. And, in a lot of cases, I've been a great resource for not only, the loan itself, but for sponsorships. We know so many people, especially in the Dallas market, that we can bring to deals that might be helpful to you, whether it's as a resource, somebody that can help guide you in a current deal, or maybe a resource that would be able to sign on a loan. Also have brought investors to deals. So your broker and your lender are your biggest partners, and that's how we like to behave. And it doesn't just stop there when we close a deal. It continues
Yep.
on, like you're mentioning, getting extensions or really finding out, hey, if we're looking at a deal and how we're going to get out of the current lender's loan and going to the next one, where does the NOI need to be? And that's really important to be able to, show your cards to somebody, and then we can advise. We really like to work on that type of transaction. We're more advisors and consultants.
Yeah. And you've advised us so well. I think. I mean, we wouldn't be where we are today if it wasn't for you and your team
Oh, thank you.
and you helping us where we needed help. So
Well, I just love this podcast because it touches on so many important things that are a lot of syndicators or new people to the investing community are not thinking about. And you do a great job. I've listened to all of these podcasts, really breaking it down in simplicity. A lot of people are putting out podcasts, are putting out webinars, and it's so high level that somebody new doesn't really understand the concept and it goes over their head. So really appreciate what you're doing here for this community.
thank you, appreciate it. And Frank's part of it too. So Frank, you haven't said much today.
No, I mean, I'm just enjoying Julie, always hanging out with her and talking. Yeah, no, what's awesome about some brokers, you've already said that, Jason, is the fact that when there's real problems, and as we're going to talk about in a few minutes, the lending market is kind of tough right now. I appreciate the how good she is at stopping everything and making the right phone calls to at least try to keep moving forward, even in dire straits sometimes.
Yeah.
No, I come with tissues too, so no extra charge on that. All right, well, let's dig in here, you guys. I want to be a great resource for your investors here. And let's kind of talk a little bit about the market, because if you are new here and you've not seen what's happened in the past, let us dig in real briefly, because so much has happened since COVID. I mean, we were digging in, people were showing up that had no experience, and they were becoming quite successful. You know, everybody had capital. We were printing money like it was donuts. All right. And so when we think about where we are today, it is a completely different environment. And if you invested in deals or you came to this market in 2020, 21 through 23, your deals are struggling. Believe me, I'm an operator, I'm an owner, and we have had our own challenges. The market today, we have seen, back in 21, the interest rate started to climb, and it climbed excessively. And most of us were closing deals using bridge. That was the way to go. That was the color of the suit, bridge. And so we got high leverage loans and we got a bunch of CapEx. So the idea was to go in, renovate, and turn these within 18 to 24 months. And once that interest rate started to climb, everything shut down. Everything really came to a halt, and the rent growth started to decline. We saw the interest rates just couldn't, a lot of deals were able to, if they had been in early in that cycle, the end of that cycle, they could get out. But a lot of us are finding ourselves with how do we keep the balls in the air? Rent growth has really slowed down, as I mentioned. Expenses, boy, oh boy, insurance climbed excessively because we had so many issues with the weather, hurricanes and ice storms and all of these things. So we have found ourselves in a pickle. And so today's opportunity is a lot different than it was 2, 3 years ago. And if you're new here, it is a great time to be in it, because a lot of these operators are starting to say, I can no longer manage this. I need to to get out. I need to sell. And that's your opportunity. There is, a lot of people are saying, hey, can I just get out for the loan amount? And in that case, we've got lenders that are just saying, hey, bring in some of the capital to do the CapEx, to get up these deferred maintenance issues, and it is yours. So you're going to need some capital, but from a lending perspective, there might be some opportunities for you. The other thing is, maybe there's some assumptions out there. I know I'm doing an assumption right now. It is challenging to get these assumptions, but they're out there. For 3.49 as opposed to today's rates, which are 5.5, 6.5 rate on an agency, it might be an opportunity for you. So I wanted to give you kind of what the color is in the market today. Challenging, but I think what we're hearing is optimistic. Is it going to happen this year? For some of these bigger deals, yes. I think we're about a year away from, if you talk to economists, depends on who you talk to. Some say, yes, let's dig in. But others will say, I want to be optimistic, but let's really face it. We're in for another year of a little bit of a challenge, opportunities for people that have capital. And really, if you're new, the time is now to build your team, to set up your relationships with people, presenting them with a deal to show them how you're underwriting it. Jason can help you with that. And then they're all ready to go when 2027 comes.
So
That's
to
how I
pause
see
real
it.
quick on that, Julie, I remember in late 23, early 24, the mantra was survive to 25.
Yes.
And then I don't remember what the story was for 26, but and obviously you don't have a crystal ball, but you're saying 27 might be the year.
Yeah, my crystal ball's from Walmart and it's broken. So it's not good. And nobody really knows what's going to happen. Probably Trump does, but I think that we're going to see come May with the Federal Reserve. They didn't move this past month. So I personally think we're going to see SOFR rates drop about 50 basis points. Some of the people that I'm listening to that I trust are recommending probably about 50 basis points. So we have a couple different indexes when we buy these assets, how we figure out the loans. Okay. We have the the short-term federal rate, which is called SOFR, SOFR. And then we also have the treasuries, the 5-year treasury, the 7 and 10. All of those you can look up online, and there are different spreads. A lender makes their money on the spreads because the indexes are determined by what's happening in the market and then the spread. The spreads right now are very tight. They're very narrow. That means that the lenders are not making very much money. It's a very competitive market. So on a SOFR, your SOFR, short-term federal rate, we're seeing that at about 376. Take the 50 basis points this year. We're going to be around 315, 316, something like that, 318, maybe 20. Then you're going to add that spread. And depending on the product that we're looking at, we're seeing those spreads around 250 to 450, depending on the location, depending on the deal that you're looking at. On the agency loans, your Fannie and Freddie, this is, we call it the gold standard. Those spreads are, again, it depends on the size of the loan, but we're seeing anywhere from, let's say, 150, 1.5% on top of that treasury, all the way up to, let's say, 250, 250, 275. Again, a lender wants to know who is buying this deal. Do you have net worth? Do you have liquidity? That's cash in the bank. And most importantly, do you have experience? And by the way, those folks that jumped in 21, 23, they didn't have experience. And a lot of the lenders said, oh, well, I'm going to look maybe a little, because we knew cash flow was coming in and everything was working well. They weren't really determined to look as deep as they maybe should have. And so in today's environment, it can be very challenging to get the agency lending.
I know when we were trying to get our first loan, we were going for agency and we
Mhm.
just couldn't do it. So I mean, even if we had experience, they're picky on the market. They're picky on the loan size. They're picky on everything. And that was
And
back when everything was going well. So now it's even tighter, I guess.
it
So
is, it is. And the thing that people are not taking into consideration is I'm 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 in multifamily and I'm going to get this acquisition fee. Okay. And a lot of people were saying, I'll use other people's money to bring into the deal. Well, lenders now are saying the GP, people that are signing and guaranteeing the loan, they have to bring at least five, and as much as 10 or more of their own capital to the deal. If you want to take an acquisition fee, you're going to have, we call it net of fees, separate from that acquisition fee. So if you think about it, what people were doing before is they were using other people's money. They were walking away with a acquisition fee and they had no money in the deal. And lenders are not going to do that anymore. They want to see that the general partners have an investment in this of their own money. So you're starting to see, hey, I got to see your bank accounts. I need to see 3 months of your bank accounts. So they're digging in. They want to see operating agreements. Are you really on this deal? Or are you a co-GP that brought in other people's money? So, needless to say, the lenders are getting smart. They are looking for the right people to be signing on these loans.
so for somebody new starting out, what do you recommend then? Partnering with experienced people, then I guess, or
Absolutely.
find somebody rich? Because I know when I first got in, I always heard you can get into multifamily with, again, no money down or anything like that, and I know a lot of people who come to Frank with deals, and they have no intention of putting their own money into it, and that's a big red flag for us, and that's a
Yeah.
Absolutely.
conversation for another day. But it's like, how does the beginner with no equity, no money, no anything even get started in this space? Is
Sure.
it
I mean, it's a great question, and I always start these conversations with, "What's the roadmap?" Like, let's figure out how much you're worth before you are underwriting these deals, because anybody can underwrite, right? And they can win deals, but at the end of the day, it's going to be who your biggest partner is, which is your lender, and are they going to want to lend to you? And so having a roadmap, which I consider a personal financial statement and schedule of real estate. First, start there. What are you worth? How much money do you have in the bank? And what is your experience? Right? So if we take, for instance, a $10 million deal, just for easy
Yeah.
mathematics here, right? $10 million deal, you're ready to roll. It works. You underwrote it. Everything works fine. I'm going to bring 70% of the transaction in a loan. That's $7 million. So if Frank and Jason are buying this deal, they need 7 million in net worth combined. So Jason may have 2 million and Frank may have 2 million. So they need to find another partner to fulfill that 7 million. All right. So this is the roadmap. Now you're out at in your networking events and you say, hey, this is who I'm looking for. I'm looking for somebody who has at least 3 million because Jason and we have four together and I'm buying this $10 million deal with 7 million loan amount. All right, so that's your first idea. Second is going to be your liquidity. On a deal that has a $7 million loan, I need 10% of the loan amount. Get out your calculators, and that's how much I need in cash. Okay, so 7 million, 10% is 700,000. Okay. Jason may only have 200,000 in a bank and Frank has another 200,000. So again, we need to find that person who has 300,000 that can bring it into this deal. Now,
Minimum.
if Jason has none and Frank has none, that person with liquidity needs to have 700,000. Those are the people you're looking for. If you don't do a roadmap, you have no idea, and you come to the lender and you're like, I want to buy this. Okay, who's your partners? Oh, I don't have any. Okay, so this is why you step back before you start underwriting and getting excited, figure out what you're worth. Again, you can use other people's money. The sugar daddy that's down the street, you could use them, but you have to know where you're going. So, and then the other thing is experience. Now, if you're brand new, and we all started there, but there are people in this industry that want to help you. Somebody helped them. Now they can help you as, sponsor a deal. Now, keep in mind, these people started at one time as let's say an engineer or a PhD, right? Or a teacher. You guys had a career somewhere and you are trying to get into multifamily. You have to start someplace. Somebody is going to help you do that. All right. So this extra partner is also, he does this full time and he's going to sign on your loan. You have to convince them and show them that you are trustworthy, really, because this guy has spent 30 years or so on his real estate world and he's bringing you on signing, and you could screw this up. And then he has a bad relationship with the lending community and he cannot run, he cannot hide. And now you've shut him down. So this person has to really trust you and you have to trust him. And that's all about partnerships. And we could spend a lot of time on partnerships. I know you've spoken about it in the past, but that is how, high level, what you're looking for in this roadmap. Now, nobody tells you that you also need to bring some money to the transaction. Yes, you have to have post-close liquidity, the 700,000, but you're bringing 3 million because I'm bringing 7, that's 10 million. You also need to put in 10% of that down payment. So think about that. You have 10% of 3 million is 300,000. Jason has none, Frank has none, so this guy has to bring it and he has to show it on his bank statements that it's in the bank. Oh, no, I can bring someone else's money. Not in this case. Or if you are using other people's money, they better have it deposited in your bank. Not saying that's the right thing, but and they may even have to sign on that loan as well. We don't want to do anything illegal here, right? So finding your team, understanding where you're going is first and foremost. And as a lender, we can help you. You can show us that personal financial statement. I can sit down and say, hey, this is where you qualify and where you're looking, you're going to need somebody that's worth this, this, and this. I hope that's helpful.
No, that's amazing because I get phone calls every single week from lenders asking me to sponsor new deals. And this is exactly the kind of stuff to go over, whether it was a 50 unit out in Idaho or even like, I think it was like we had a 9-unit rebuild on Martha's Vineyard in Massachusetts. They're asking me to sponsor stuff like that. So, yeah.
Yeah. So you would hate to have Frank, shut down because this is what he does. He does. And this is how he takes care of his family, is in real estate. So you have to be very careful with your relationships, like one with Frank and with Jason.
So what you were saying back when the GP team needs to bring in, say, 10% or what, 300,000 of their own?
Yes, that's correct.
And you said, well, it could go onto a bank account or something. I bought a single family home many, many years ago. I took out a loan from my parents. They wired me the money, and the bank, I did a conventional mortgage. So that's how the route I went. The bank looked at that and says, well, where'd this 25,000 come from?
Yes.
And I was like, well, it came from my parents. It's like, well, we just need to see their PFS and all that stuff. And we're like, why? It's in my bank. And it's like, oh no. It's like, well, you can either wait 60 days for it to season, or I need their information. So I had to wait 60 days to close on that deal because they didn't like that I had somebody else's money. Do they do that in this case also with agency type?
Yes, they're going to want to see where that, did it all of a sudden show up and where did it show up from? So really be thinking about that. Again, the roadmap is really a great place to start so you can get your partners to and talk about this. We as partners would be great if everybody knows where, how the sausage is made and who has what, right? Really important. Now, you had asked the question, how does a new person do this? Okay. It's going to take some effort. You're going to have to go network with people, right? Now, you might say a new person, they have a net worth of $6 million because they've done well in life. You can buy without your entourage. Okay. You don't necessarily need a partnership with other people. However, wouldn't you want to have somebody help you hold your hand? Now, in my situation, I got up to 20 units and a bunch of single family, and the lender said, go away. Just go away. I can no longer give you any more money. And they said, hey, go get some partners. And I said, absolutely not. I'm not going to have partners. I don't trust anybody. And that was the biggest downfall for me. I wasted about 15 years of trying to do it myself, buying, selling, holding, trying to make, shift money here and there. Had I stopped right there, picked up a couple partners, I would have been able to take on larger deals. But I was bullish. So somebody who has all the network, the liquidity can do this themselves. I would say you're probably looking more at a bank loan, not necessarily an agency loan. A bank loan is your local bank, your regional bank, your national bank, maybe somebody that you're currently running your business through or your personal finances through. That might be a solution for you. Your banks are looking for somebody who lives local to the transaction. If you live in Dallas and you're buying in Fort Lauderdale, that bank doesn't feel comfortable that you, if something happens, that you're going to be able to get on a plane in a split second because you don't do this full time. You're a doctor, you're a lawyer. They want to feel a sense of comfort. So we would look for banks that have done business with you and have a relationship in that Fort Lauderdale, that they have a location there as well. Bank lending, a little bit different than what agency is. It's non-recourse versus recourse, which I'm sure you guys are going to talk about when you dig in further on lending, your lending format coming up, your series.
Yep.
So you can do this by yourself. You're going to need a property manager. No bank is going to give you money without knowing you've got somebody alongside you.
Yeah, property managers are super important. Especially the first time, they're probably not going to loan you money to do it yourself. That'd be pretty tough. I mean, unless you
Certainly.
had some kind of massive experience in it, but most of the time we're talking about, no, you're starting out. So,
Certainly. We talked a little bit about the market and the opportunity. And we're thinking about the deferred maintenance that some of these operators were not able to get done because they didn't have any more money in the transaction to be able to, do these renovations. An option, and again, you're going to be talking about this in your lending series, but high level, there might be a bridge loan opportunity where a lender will see the opportunity. They look off into the future. Oh, I love this opportunity. You're going to renovate it for us. You're going to bring in a new kind of tenant. The previous owner, they brought in not so good of tenants, but I see your vision, and you're going to renovate it really nicely and put in, let's say, $10,000 a door. Well, you yourself don't have the $10,000 a door, but a bridge lender can bring this CapEx budget. They'll roll it into the loan and you'll do the renovations and then they will repay you. So those are bridge loans. I think there's a place and a time for them. New investors want to be really careful with bridge loans. You really have to have a good team to use bridge lending because, again, what did we see? The rates go up and nobody could operate these deals. Again, thinking about where SOFR is, the SOFR, the Federal Reserve Index, is going to be hopefully going down. So just like an adjustable rate on your home that goes down, that's great. But hopefully it doesn't go back up. And then you can get out and maybe either sell it or then you go into this agency, your Fannie and Freddie product.
Yeah, we had a bridge loan on one of our first deals, and we were planning on going to refi it in like 2 years or whatever and get a lower interest rate. But unfortunately, as soon as we bought it, interest rates started climbing, and nothing could compete with the rate we actually had for that bridge loan. The bridge loan was lower than anything else, so it was really
Yeah.
hard because we had to stick with it because we'd be costing us more debt service to get into something else. So
And
we
that's
chose
and
not
that's
to.
where we came in, right? And we
Mhm.
say, okay, your NOI needs to be from here in order to bridge over to this other financing. We need to go from 100,000 to 200,000, just an example
Yeah.
like that. And getting that insight from a lender is really helpful. So then you can get with your property manager and say, hey, we've got 12 months, we've got a maturity coming up, and I need to make sure that we're working along this timeline to increase that NOI. And that's really the function of working with a broker and a lender, that we can help you dissect where you're going. You always want to know, again, going back to the roadmap, how much let me step back. My investors, how long will they want to be in this deal? If
Mm.
I've got a bunch of young people, they want to move money back and forth really quickly, and they don't really care because they can make up that time if they don't the transaction doesn't do well. So they may want to be in transactions 3 to 5 years. I'll tell you, we should not be thinking 3 years. We should be really thinking more like 5 to 7 years. So you want to marry the deal that you're looking at, the loan product that you want. Make sure that those marry to the deal, and then marry the investor to that deal. Why underwrite a 10-year loan if you have investors that want to get out in 3 to 5 years, right?
Yeah.
You
Yeah.
want to put those two together. Very, very important. Again, the lender drives a lot of your success in being able to deliver on the investor's capital.
But I was also going to say the times that we're in are weird right now with climate interest rates or whatever the last couple of years. You could be doing everything right, getting your NOI up 300K over what you were expecting. But with cap rates climbing, also, that 300K now is not as much as it would have been a year or two ago. And so now you're not even able to get the loan proceeds you need to refi out of it. So we saw that on one of our properties as well. It's like we boosted the NOI up, I guess maybe 250 or whatever, but it needed to go another more just because we bought it at a 5.5 cap, and banks are refining at 7.5. That's like a huge kick in the pants when you're trying to get out of a loan into something new. So
Yeah, and cap rates are really hard to determine, especially in this market. There hasn't been enough sales to say, oh, we're in a 7 cap. Or, a lot of agents or brokers want to say, well, it's a C, therefore it's 7. It's a B, it's therefore 6. It's an A, it's 5. Well, not necessarily.
yeah.
So, the compression that we experienced after COVID really was difficult because everything, A, B's, and C's, were all in the threes. Now they've completely widened, and we're having a hard time determining what the real value of these assets are. And I think that's still I don't think we're at the bottom necessarily. I think we're getting there. Depends on, I think A's are moving forward. I think C's still have some understanding of, okay, who's living in these properties? Are these residents, are they being looked at differently? Like, is ICE showing up where it might be a concern? So, all to say, it's a challenging market. Things are moving. They're looking more positively. We just got back from NMHC, and we're going into some, positive things are on the horizon for sure. But again, a great time to get in because you got to be building your team and your strength, right? Your muscle memory of how to underwrite these deals, and
Yep.
building that team with your lender, with your other investors, and so forth.
Yeah, the market's definitely in a weird position. We're trying to close a deal in Charleston, South Carolina,
Mm,
and the seller's getting hammered because he still has floating rate debt on it. So
hmm
every month they're losing money. So it's a big deal too. So
It's a good
luckily for
market.
us, so
I
again,
like
it's a
that.
great
I
market.
like
Yeah, I
I
love it.
like that. Yeah.
It's 312 apartments, so
Mm-hmm.
506C, so I can mention it. But we're buying it for like $48 million, and they're going to take a bloodbath for
Yeah,
what they paid for it.
sure. I've seen deals where they bought it at 92 a door. They increased by the renovation, they brought it to 125, and it's not worth more than 75 a door now.
Ouch.
Yeah, that
So
blows my mind.
tough.
Well,
The other thing I want to make sure is you understand, as a lender, I don't care if you are making 13% IRR or 150% IRR. All we care about from a lender's perspective is that you can pay the bills, that it covers at a 125 or a 120 or a 135 debt service coverage ratio. So there's concern. People say, oh, I don't want to show you my underwriting. We are your partner. We are
Right.
in this together.
mhm.
Again, I don't care if it is the best thing and you guys are going to make tons of money. I don't care. I just want to know that we're going to get paid and my lenders are getting paid. So all to say, be transparent. Share with your lenders what you're trying to do and how we can help accomplish that hand in hand, mano y mano, to help you do that.
I don't think enough investors, especially new ones, but even long-term ones, treat lenders as partners.
I agree with you.
Sometimes they're the mean partners who are like holding your feet to the fire and you don't like it and make you
Yeah.
feel totally uncomfortable. But I mean, it's still required, and that they need to get paid, so they're going to make sure that you do that.
Yeah. I mean, it's kind of like dad is coming home, right? And mom is trying to tell the kids, hey, dad, when dad gets home, you're going to get a talking to. So, yeah, I mean, at the end of the day, you have made a commitment to the lender, and it's always important to have those conversations. This is where we're struggling, you know, listen, are they going to say, oh, no problem, don't worry? No, they're going to try and say, hey, what can we do together collectively to figure out where you're maybe some shortfalls? They're not going to run your business. They're going to expect to get paid. But again, it's a partnership. So how do we do this?
So let me ask you this: what happens if maybe your debt service coverage ratio drops below 1? You can't pay your debt service, and it's like, what do? You hand over the keys and say we can't do this, or will the lender work with you on that and come up with different loan modifications, or what have you seen in that? Because ultimately, I don't think the banks or Fannie Mae or whatever want to own a property and run the property. They just want to hold the note, right?
That's right. They are not operators and they don't want to be operators. In commercial real estate, there's this word, depends. And it's not the underpants that you wear when you get older, okay? Or you go to the New York, what is it? The New York,
New Year's Eve.
thank you, New Year's Eve. You might wear diapers there. But it depends. It depends on the situation. It depends on what you're really struggling with. It depends on where you are in the loan. It depends on the location. There's a lot of things that go into making a decision from a lender standpoint of where they're going to either give or they're going to take, meaning I'm going to find a seller. You're going to sell this to this other buyer, finding a solution for you, for them, maybe for somebody else as well. So there is no, it's either black or white. I think there's a gray area. I think, to be honest with you, this year is going to be a big determining factor of what happens with these lenders and these deals. Either these lenders are going to be like, hey, I gave you this money. You can't afford it anymore. I'm taking it back. I'm putting it on my books. Okay. And I'm going to hold it. I was talking to a lender at NMHC that is still holding onto their 2008 properties because they
What?
took it back. Yeah. Well, it's a cash flowing cow now, and that helps, you know, bring money to the company. So um, again, it'll depend on every lender that we talk to, what their strategy is, what their acceptance is, what they tolerance. So yeah.
Okay.
Cool.
I think we could probably talk for hours and hours about lending. So you might have to come
Yes,
back again.
it would be my pleasure.
Because
I love what
there's
you
some
guys are doing.
there's some things I wanted to touch on, but it's like we've already been going for 40 something minutes and I want to give my listeners a break. Um,
Go get a coffee. We'll come back shortly.
Well, Jason, one of the things we could do is you and I could do a few episodes where we deep dive, and then if there's follow-ups, you could always invite her back, stuff like that. We'll see. Or maybe we'll
Definitely.
just do a 6 month and say, hey, how's the market changed?
Yeah.
Yeah.
Well,
Well,
I'm a
it's always like,
subscriber, so I'll listen to what you're saying, and then we can circle back and say, oh, there was a couple, two things that I didn't hear you guys talking about, and let's cover those now. Whatever works. I'm happy to
well,
help.
since you're a subscriber, also, if I ever misspeak or say the wrong thing, I want you to call me out on it. So, because
Privately, not publicly.
That's right.
no, I would rather you do it publicly because I want to give my listeners like accurate information. And if I'm saying something wrong, I want to know about it so I can change it.
Now, if she does it privately, you can follow up on the next episode and say something.
There you go.
I think
Well,
we
this
have
has
a
been
good enough
great.
relationship that it doesn't matter if it's public or private. So
Thank you, Julie. Always a wealth of knowledge.
Thank
Yep,
you.
thank
Anything I
you.
can do to help, let me know. Appreciate it.
All right. Yep. I appreciate it. And how can people get a hold of you if they want to learn more about lending or want to use you as a broker?
Yeah, so on all social medias, Julie Anne Peterson, Julie Anne, A-N-N-E, don't forget that E Peterson. I'm on Facebook, on LinkedIn. We also I run a Zoom at 8. Love to kind of pitch that. It's for all kinds of investors. We have every Tuesday night at 8 p.m. Eastern. We have networking and we have industry experts come and speak to you on how you can improve or a service that they provide. And then you break out into sessions where you can meet other people who are in the room and get to know them because you may need a sponsor, you may need some investors, you may need a bank. We're all there every Tuesday night. So you can sign up on that at Zoom at 8, ZOOMAT, the number 8.com.
All right. Well, cool. And it'll be in the show notes and comments or description or whatever. So if you missed that, it'll be there too. So thanks again, Julie. And yeah, we'll definitely have you on again. And we'll catch y'all next time. Bye.
Sounds great. Thanks for.
And that's a wrap for this episode of the Ironclad Underwriting Podcast. If you got value from today's conversation, make sure to subscribe, rate, and share the show. And don't forget to connect with us on LinkedIn, YouTube, Facebook, Instagram, or check us out at our website at ironcladunderwriting.com for more insights and updates. If you have a question, a deal you're analyzing, or a topic you want us to tackle, shoot us a message. We'd love to hear from you. Until next time, keep your assumptions grounded, your models sharp, and your underwriting ironclad.